This video is only for educational purpose. In this video, how the mutual funds works and different types of mutual funds available for an investor to choose and invest for a long term. To grow our money for a long term, one of the options are mutual funds. When investor invests in mutual funds, the fund manager will invest in various securities available in the market and they will provide return to the investors. For the service, the mutual fund company will collect some service charges. Through Angel 1, Angel B mutual funds app, we are going to see different types of mutual funds available for an investor to invest. First one is the equity mutual funds and the second one is the balance fund. It's a combination of equity and debt securities. The third, the debt instrument, the mutual fund company select and invest. Next one is the tax saving mutual funds that investor can select for saving their taxes. You can also calculate your average return when you invest for a long term. Tax saving mutual funds are mostly invested in government related securities and infrastructure projects. Investors choose right funds by comparing other mutual fund companies. Credit rating agencies generally rate the funds based on previous performance. You can also invest a lump sum and as a SIP. Both the option has a minimum investment requirements. This fund, the minimum requirements is 5,000. Based on previous performance and credit rating, we can choose our investment. It's good to diversify our portfolio by investing in different mutual funds. If we invest for long term, the mutual funds may provide multiple returns. Once the funds are grown, it's time for us to harvest our investment, taking our multiple return back by selling the mutual funds. Subscribe and thanks for watching.